Good morning, everyone. Welcome to Ad America TV. My name is Anton. I'm one of the e-guides here at Ad America. And Ad America is the U.S. Embassy's American Center here in Jakarta, and our mission is to provide a space for young Indonesians to learn more about the United States. Welcome to all of our audience joining us online, and welcome to those of you who are joining through Zoom. For those of you who are in Zoom, you can use the chat box feature to interact with each other and also ask questions to our speakers this morning. And we are now once again tuning in for another session of financial resiliency from millennials during the pandemic. And before we begin, I'd like to give you guys an icebreaker question. And the question for today is, to maintain a low debt-to-income ratio, what is the maximum amount of our take-home pay we should use for monthly debt payments? Is it A, 10%, B, 15%, C, 20%, or D, 25%? I'll repeat the question one more time. To maintain a low debt-to-income ratio, what is the maximum amount of our take-home pay we should use for monthly debt payments? Is it A, 10%, B, 15%, C, 20%, or D, 25%? You can answer this question in the comment section of our social media. And now, without further ado, to start today's event, I would like to invite our moderator, Mas Budi Setiawan. Please take it away.
Okay, thank you so much, Mr. Anton, for the introduction. Good morning, everyone, and welcome to Air America. Today, we are going to continue our third, and I think it's the last live streaming workshop discussing about financial resiliency for millennials during the pandemic 2.0 atau ketahanan keuangan generasi milenial pada situasi COVID-19 pandemic. As we know, COVID-19 pandemics leads uncertainty in economics all over the world, including Indonesia. Decreasing economic activities due to the rapid spread of COVID-19 has an unprecedented impact on the financial market. In addition, from the Indonesian perspective, the stock market in Indonesia decreased from 6,000 to 100 something at the beginning of this year and reached below 4,000 in March 2020 and 20. Since the stock market moved up and stable in the level above 5,000 from mid of July to present. Yesterday, Jakarta Composite Index or IHSG was closed at the level of 5,571. It means there has been high volatility in Indonesian stock market during the pandemic outbreak. Today we will talk with JJ Wenrich. He is a financial consultant and also book author about basic of stock analysis and discuss when we need an advice from a financial professional or maybe we just want to invest independently. Anyway, during the virtual webinar, the audience can ask questions on an America social media through Zoom, Instagram, Twitter, Facebook, and YouTube. Before starting, I would like to introduce our main speaker today, Mr. Jajan Wenrich. JJ is a 20 years veteran of the investment world. He is known for simplifying complex concepts in a fun and approachable manner. He is a keynote speaker for financial advisors, corporations, nonprofits, and other organizations. He is a certified financial planner professional and holds the certified financial education instructor from the National Financial Education Council. In addition, he spent 13 years as an investment consultant financial professional for a national investment firm before leaving to publish his book and follow his true calling of educating and advising individuals, families, and organizations on the importance of making good financial decisions. So, without much introduction, JJ, time is yours.
Thank you, Booty. I appreciate it. And thank you to everybody that's joined us listening in today, Saturday morning. Happy Saturday to you. And happy Friday from California. It's still Friday night here. We're still in Friday mode. So hope that you are having a good morning so far. Appreciate the introduction, Booty, and appreciate Out America for having me here today. Hopefully we will get into some good information that will help you understand a little bit more about how the markets work, how stocks work, and how investing might apply to you and to your life. So this is the third of 3 sessions, as Booty mentioned, and just want to say that it's been a lot of fun for me to be involved and talking to the Indonesian people, and hopefully can continue to do so in the future. With that, let me dig in. Let me see if I can share my screen. Let's see, it seems to be working. And if you have questions, as everybody has mentioned, feel free to put them in the chat. If you're on the Zoom, if you're on the social media or elsewhere, put them in the comment and they'll get those to me, and we'll try to make this a good interactive session. We have plenty of time for Q&A in this week's sessions, so feel free to ask questions. Happy to answer questions about anything that you might think of. Let me see. Does it look good? Is my screen? Let's see. Let me get my slides going. Okay. So hopefully you see my slides. Let me pull the chat up so that I can see if you guys are talking to me, and we're in great shape. Okay, so if you can't see the slides, somebody hopefully will let me know. Otherwise, I assume it works. Looks good. Okay, thank you. All right. So here's what we're going to talk about today. Maybe. Yes, we are going to talk about this today. So, do it yourself, DIY, do it yourself versus using a financial professional, as Booty had mentioned. We'll cover that. We'll get into actually a pretty good depth of stock analysis, talking about what do people look for when they look at individual stocks versus looking at funds. You have that decision: do I buy individual companies if I'm going to invest in stocks, or do I buy funds? And so we'll talk a little bit about how to analyze each one of those. And then we'll talk about building your portfolio just to wrap it up. If you decide that, all right, I need to start saving, and I also want to start investing, how can I begin to look at doing that, building that portfolio that that is custom for you? So hopefully this will wrap it all up. Again, if you have questions along the way, don't hesitate to ask in the chat or in the comments. So let's kick it off by talking about doing it yourself versus hiring an advisor. It's a question that a lot of people face in the United States as well, is do I just do this on my own? Because with technology, you can do most anything on your own now. When I was growing up, you needed to work through somebody, you needed to work through an advisor just to mechanically do it, because you couldn't just open up an online account because there was no online. But nowadays, with everything having gone online, you do have a choice of doing it yourself versus hiring an advisor. But there's still plenty of good reasons why you may want to hire an advisor. Now, keep in mind, it's going to be different in Indonesia than it's going to be in the United States, but hopefully I can at least give you a little bit of the United States perspective. And Booty has agreed that if there's anything that he can share, he will, to help give some of the Indonesian perspective as well. But advisors, they can help you with motivation. If you have somebody that's going to be there giving you good advice on where to save, how to save, what to invest in, it can be good motivation. Kind of like if you are trying to get in shape and you need to work out, sometimes it's good to have a exercise partner or an exercise trainer, and give you just the discipline to keep doing it, to knowing that they are expecting you to deposit a little bit of money every paycheck can help give you some of that discipline. They can help you with the expertise, both in figuring out what should you invest in, what's the most appropriate investment for you in your situation, but also if there's any other considerations that you need to navigate. I know in the United States, a big thing that I help my clients with is navigating the taxes involved with investing, because there's different tax plans based on what you're investing towards. So in the United States, if you're investing towards retirement, there's all sorts of ways you can do so and get tax breaks for doing it. Same thing for college savings plans. So having that expertise can definitely be worth paying a little bit more for the advice, and just having that counsel, having someone to talk you through your decisions. Those are all roles that advisors can play. But keep in mind, nobody works for free. And so it may be more expensive. It will probably be a little more expensive to work with an advisor rather than doing it all on your own. There's been some studies in the United States, not a lot of studies, but some studies on what value do advisors bring to relationships. And it's been fairly inconclusive. But one of the main values that I can say that I know that advisors bring is just helping you to not do the wrong thing at the wrong time. Oftentimes our nature is to have us to want to sell when things are down. And a lot of times an advisor will prevent us from doing what we know is probably the wrong behavior, but it's just really hard to keep yourself from doing it sometimes. But it may cost you a little bit more, and there may be some conflicts of interest depending on the advisors you work with. I remember in our last session that one of the gentlemen from Indonesia said that there's much more licensing and more of a regulatory environment in Indonesia than there used to be when it comes to financial advisors. So it sounds like you want to make sure that you find somebody that is registered, that has all of the proper things that they need to be licensed to give advice, because not all advisors have the same expertise. Not every advisor is a great one, at least in the United States, and so you may want to get referrals from somebody you know, or shop around if you don't know anybody. Some questions that I always tell people to ask is, you want to find out, how are they paid? How do they make their money? What are the costs and the fees associated working with an advisor? What are their specific qualifications, years of experience? Why should you listen to them? What types of investments do they typically recommend? You may find one advisor is mostly mutual funds, maybe another one is mostly individual stocks. So you want to find out, what does their typical recommendation look like, and how do they determine what to recommend? And just, you want to ask good questions about what's their investment philosophy. How do they decide what they would recommend a client purchase or to not purchase? Is there anything that they are against? So kind of getting back to our agenda, hopefully that gives you a little bit of an idea of just some of the questions you would need to ask both yourself and anybody that you might work with. Like with anything, if you have people you know and trust that work with financial professionals, always good to get a referral in that manner. So with that, let's kind of dig into a pretty in-depth discussion of investing. We've kind of tiptoed our way into this up to now in the previous two sessions, and now we're going to dig in and have some fun talking about some of the numbers and the things that go into analyzing stocks, and then also analyzing funds and then putting that together in a portfolio. So again, we've got individual stocks versus owning funds. It's one of these age-old debates that you'll see on Twitter and amongst people arguing about things is, do I own individual stocks or do I own funds? And you don't have to decide. You can do both, or you can do one or the other. A lot of times it makes sense to have the bulk of what you invest in funds, in things that are naturally diversified, and then maybe have a few individual positions around the edges. Otherwise, there's nothing wrong with having everything in funds as well. If you have everything in individual stocks, make sure you have the expertise or working with someone that has the expertise to do so. Don't want to do that just without putting some serious thought into it. But let's start by talking about individual stocks and how to think about individual companies, how to analyze them to some extent, and hopefully help you understand a way to look at stocks in a way that you had not before. So when you're looking at an individual company, stock analysts, what they're trying to do is project the future. You're really trying to predict the future. You're trying to project what might the future assets of the company look like, what might their future business look like, how much might their earnings be in the future. You're trying to come up with, what am I willing to pay for this business today based on what I think it's going to be worth in the future. So it's all about projecting out, what is this business going to either pay me along the way in the form of a cash dividend, or what might I be able to sell it to someone else for down the road. So it's all about figuring out the direction of things. I always tell people, when you start to think about stocks, stocks follow a path, and they tend to follow the path of their business. I mean, think about it. If you own a restaurant, is your restaurant worth more when there's a line of customers out the door, or is it worth more when you're standing in the doorway looking for customers? Well, it's worth a lot more when there's a line of customers out the door. Same thing with stocks, because stocks just represent businesses. They represent companies. So stocks follow the direction of the story of that business. They follow the direction of the numbers that go along with that story. And they follow the direction of expectations. So if expectations are that everything is going to get better, then that can help push stock prices up. But if expectations are that everything is going to get worse, then that could push it down, and then vice versa. Sometimes the expectations aren't in reality, and you'll see that suddenly what everybody thought was going to happen maybe doesn't. and suddenly prices change their direction. So there's all these factors that kind of weave their way in and out of each other that really determine what happens to the price of a stock. So it kind of comes back to story, numbers, and expectations. So let me start with story. Pretty simple. We're looking for good businesses. Although it's easy to forget sometimes, a share is not a lottery ticket. It's ownership of a business. And that's from Peter Lynch, one of the more legendary investors in the United States. Ran the Fidelity Magellan Fund for about 20 years and did incredibly well with that fund. But it comes down to, you're looking for businesses. You're looking for companies that you wish you owned. So that's the bulk of the story. It goes more into it than that. What's going to happen to this story down the line? What is the reason I might want to own that story? But in essence, it's, what's the story of this company and why should I want to be an owner of that business? And that leads to the numbers. Some of the numbers to quickly think about. You can get drawn into thinking $100 stock price means it's a $100 company, and a $50 stock price means it's a $50 company. But that really only tells you the stock price. It doesn't tell you the value of the whole company. The value of the whole company is the stock price times the number of shares, or the market cap. So, stock A that has $100 per share but has 1 million shares, it's not worth as much as stock B that has $20 per share but it has 100 million shareholders. You see, one's worth 100 million, one's worth 2 billion. So when you're thinking about how much is the company worth, that's why it's important to look at that market cap number, which is just the price per share times the number of shares. So if you look at Apple, Apple Incorporated, their market cap of just under $2 trillion if you look at a stock quote for Apple, just for a little bit of comparison. I'm going to keep going back to this quote as we go for the next several minutes, just to help you understand some of the numbers that go into analyzing a company. So, there's one place to start. You look at $2 trillion. We're not going to find too many trillion-dollar companies out there, at this time, but Apple is one of them. So, if you own stock in a company, they may pay some of the money that they make in the form of cash, which is called a dividend, as we've covered in some previous sessions as well. If you take the actual dollar amount of that dividend and divide it by the share price, it gives you the dividend yield. And then another thing that's really important to know and understand is the earnings. So the earnings per share of a company, quite simply, it's also, think of it as the profits. Everything that you sold minus what you paid for it, that's your profits. All your expenses out of the way, how much did you actually make? And so we do it per share because it's easier to think about things in a per share basis. So earnings per share, that's really important. That's your profits. If you own a company, your goal is to make money. Your goal is to have profits. And if you own company by owning shares, same thing. You want your earnings to go up. And so that's why analysts spend a lot of time trying to project, what are earnings going to be? What are sales going to be? What are the numbers going to be? Pull up a stock quote. You might see here for Apple that we've got the dividend yield at about 82 cents per share, just under 1%, about 0.69%. Dividends can be raised, they can be lowered, they can be cut. Apple has been on a trajectory where they've actually been raising their dividend since they first instituted it about 5 or so years ago. Just see quickly that each quarter this dividend has gone up a little bit, or each year it's gone up a little bit. Earnings, I said earnings were important, so EPS, that's earnings per share. Notice $3.28 for Apple on their current most recent earnings. If you're looking at owning companies, part of what we're trying to figure out is, what are those earnings going to grow to? And so when you pull up a quote for Apple, you can also dig in and find an estimate where that's from Yahoo Finance, but they will give an estimate of future growth. And so it looks like that they're estimating that Apple's earnings will grow about 12%, 12.64% over the next 5 years. It says over the past 5 years, it's grown at about 8%. Next year, it's expected to grow about 9%. So if earnings for this year, and I screwed up these numbers, so these were supposed to be divided by 5. So I apologize that these are pre-stock split numbers. But before the stock split, earnings were projected to be $13.19 this year, but expected to grow at 12% for 5 years. So what are future earnings expected to be? And again, this is Apple's stock price split this summer, so it was a 5-for-1 split. So the numbers are a little bit weird, but we can still go through the exercise. So if this year they were $13.19, up by 12%, up by 12%, 12%. You see by 23, we're at $18.53. By 24, we're at $20.75. And then 5 years later, we're at $23.25. So earnings have grown over $10 per share over that 5 years. Doesn't mean that you actually get that money. That's just the profit of the company internally. You only actually get the money of the dividend. But if you're trying to see how much are my shares maybe going to be worth, this is one way to think about it, is what might the earnings be in 5 years if estimates are true. So if earnings are around $23.25, what might you be willing to pay for $23.25 in earnings if right now you're willing to pay what you are for $13.19 in earnings? And so again, you see my earnings numbers down to 3 because the stock split. But the PE ratio here is how you kind of see how much you're paying for each dollar of earnings. So let me explain this ratio. It's a little bit hard to understand at first, but it'll really help you understand this is how people value businesses. This is how people value stocks. So the price to earnings ratio is just simply the stock price divided by earnings per share. So we take our stock price, which was around $117, divide that by the earnings per share, which was around $3.28, gives us a PE ratio on Apple of about 35. So represents the price per $1 earnings of Apple. So you're paying about $35 for every $1 of earnings, of their current earnings. Now they're projected to grow their earnings. So another way to think about this is if you call the price to earnings ratio, think of it, call it the multiple. And so if the price to earnings ratio is considered the multiple, if you take earnings times that multiple, just do the arithmetic, that equals price. So if we go back to my previous example here, what would you pay for $23.25 in profits? Well, that's where you would use that PE ratio, multiply it times that multiple. You know, currently today, if you use that multiple, 13.19 times that, it would have been, in the 500s because it was pre-split. But we can do the same thing looking forward. So if earnings are projected to be 23.25 and 25, what might the stock be worth in 25? What might that multiple be? So maybe 465 if it's at 20 times. The current multiple of over 30 be over 700 per share, or times 35 is up to 800. Now again, that's pre-split. So if you divide that by 5, that would be the the post-split price. But that's the idea, is you grow the earnings and then you see what you might be willing to pay for those earnings. No different than if you own a restaurant and you're selling that restaurant, whoever's buying it's going to say, well, how much are you making? And they're going to offer you a multiple of what you are making. Same thing with stocks. So if you're looking for which stocks you want to own, you want the ones that are going to grow their earnings, because that's going to be the ones that can grow their share prices. The share prices tend to follow the same path as sales and earnings, and then stocks will follow dividends. Companies that continuously raise their dividends tend to continuously have good stock prices. Maybe not every month, maybe not even every year, but over long term, 5 years, 10 years, the companies that are consistently growing their earnings and are raising their dividends, those are the ones that do the best over the long term. But one more thing, stocks don't just follow their own path. They also tend to just follow what the rest of the market's doing. So if the whole market is down because of COVID or whatever is going on, then even a good stock that the business isn't affected by what's going on in the whole market, it's going to be affected as well. So on any given day, if your stock is moving up or down, it might have as much to do with what's just going on in the market as anything else. So again, we talked about story, we talked about numbers, and then expectations. There's always expectations built into stocks. There's always expectations that things are going to be different in the future. And when suddenly news comes out that changes those expectations, well, then prices will change as well. And so you have to always be looking around the corner, because there's so many expectations that are just built into stocks that any change in that can really change the prices in a quick manner, and you have to be ready for that. So we've talked a little bit about two of these three. We talked about doing it yourself versus using a financial professional. Talked a little bit about stock analysis. Now we're going to dig into some fund analysis. Yes, sir.
Yeah, JJ, thank you so much for the presentation. I think before continuing your PowerPoint slide, I think thanks for giving us with Apple as an example. As we know that Apple is one of the large or big cap stock in USA. Is also there is also a question related to the your example from the participant on YouTube. JJ, what do you think about the investing in big cap and also small cap? And the question is investing in small cap more profitable than large cap? What do you think, JJ?
Yeah, no, it's a really good question, and I'm actually going to talk a little bit about that as we go into the next couple sections. But I'm going to answer the question anyway. Now, so small caps, it's definitely going to be riskier than large caps, because one, it's smaller companies, but also it depends on where your small cap companies are. So if you're buying Indonesian small caps, if you're buying just general global small caps or US small caps, each one's going to have a different level of risk to it. Over long periods of time, those small cap funds, small cap stocks have done pretty well and have done better than large cap, although not lately. And it also depends on the area of the world. In the United States, large caps have done so much better lately, but small caps, they're trying to, have had a good couple weeks. But if you look over 100 years, small caps have been the best performers. Internationally, I think small caps have done, probably, relatively better compared to their larger cap rivals compared to what's happened in the US. So I think it can be a good, as a portion of the investment strategy, to have maybe one slice of the pie be dedicated to small caps or mid caps, or maybe a combination of both. But it also depends on which country you're talking about as well. So really good question, and I'll hopefully that helps answer it. And and then I'll touch on it a little bit more as we talk about putting portfolios together.
Okay, JJ, thank you. I also agree with you that we need to put the portfolio together. I mean, with the small and also large cap in our portfolio. Okay, JJ, you may continue your presentation.
Okay, awesome. So Yeah, so we talked about individual stocks, talking about funds, leading us right into what that question kind of pushed us in that direction. There are so many types of funds, just so many types of funds, especially in the United States. I don't know if it's the same way in Indonesia, but in the United States, there's more funds than there actually are actual stocks, which is pretty remarkable if you think about it. But some funds might have both stocks and bonds in it. Some might have just dividend paying stocks. Some might have only companies that are trying to grow their earnings. You might have funds that only invest in energy companies or only banks or tech companies. We were talking about small, mid, and large cap stocks. Different countries, you could go country specific with the fund. Maybe if you want to only own Japan or only own the United States, or only own China. I don't know, whatever it may be, or maybe something that just owns a little bit of everything. Couple categories of stocks that not every stock fits into one of these categories. These are just general terms that people use, but sometimes it can be tough to define a particular stock as, hey, this is a growth stock, or hey, this is a value stock. But growth stocks generally are those where they have the potential to grow their earnings. You're focused on the E in PE, if you will. So they have the potential to grow their earnings at a higher rate, versus a value stock or stocks that might not be trading at such a high PE ratio. They're considered cheaper. There's value there. In the United States, we'll often separate funds out by style box. Morningstar is the company that kind of developed these style boxes, and it uses a combination of that growth versus value spectrum, as well as large cap, mid cap, small cap. At least that's for the stock and equity side. For fixed income, they'll separate it by credit risk, high risk to low risk, and then short duration to long duration in terms of the term. So oftentimes, if you are managing a fund, you're just trying to beat the other peer group, the other funds that do the same style box as you. So, not all funds fit into a style box, but a large percentage of them do fit into one of these 9 style boxes. Also, funds, we've covered this before, they may or may not be designed to beat the return of a particular market or an index. If the manager is trying to beat the return of the index, it's an active fund. If it's just trying to match the return, then it is a passive fund. And if you're going to pay usually a little bit higher fee for an active fund, you just want to make sure that manager has a history of beating their particular market or index, which leads us right into analyzing fund performance. Every fund has an index that it's compared to, and you want to look, is it beating its benchmark? Is it doing what it's trying to do? If it's not, then you could have just owned the index for cheaper, and maybe you do just want to own the index. There's, that can be perfectly sound way to invest, is just to own the index and not have to pay as much to do so, because index funds tend to be cheaper than active funds. So if you're looking at funds, you can screen by a category. And then what I like to do is I like to compare the quartile, compare it against its peer group. Is it in the top half over 1 year, over 3 years, over 5 years, over 10 years? And you look for ones that are consistently in that top group, that, in the top third to half of their peer group. And then you may want to dig in a little deeper and see, how did they get there? Are they, did they do something different to give them that performance? But that's generally how I screen mutual funds, is I look at their performance and look at how they compare to their peers over multiple time frames. When you're analyzing funds, you want to look at what's it cost to own it. There's usually an expense ratio that is going to be taken out of the return, so you won't really see this come out. The return won't be as much because of that cost. but there also may be costs of getting in and out of the fund. So you want to make sure that you understand all of that. Just like if you're looking at financial advisors, you want to make sure you understand how the cost of their advice may be incorporated into the investments that they recommend. If it's a mutual fund, that especially an active one that you are expecting to try to beat its index, you want to make sure that it's the same manager that's been there giving you those numbers, because oftentimes managers change and the numbers do too. And you tend to see what happens to that fund when things go wrong and when things go right. I always like to analyze, all right, what did this fund do in a really bad year? And also, what did it do in a really good year? And see, does it capture all of that upside, or does it capture all of that downside, or does it fit somewhere in between? Or maybe it captures more than the upside, but also captures more of the downside. So you just want to help use it as a piece of your analysis. So we've talked about two of the three now.
Okay, JJ.
Yeah, Budi.
Okay, since you are talking about growth stock and all the value stock, there is a question related to the second topic. The questions from the participant on Instagram is: do you recommend buying small companies that have high expected growth or bigger companies that have steady growth?
So say it again. That have high.
Okay. Which one do you recommend? Small companies that have high expected growth or bigger companies that have steady growth?
The steady. Okay, yeah, no, really good questions tonight. So higher growth.
Yeah.
Obviously, it depends on your situation. There's so much that goes into that. In general, I would say own a little of both. I mean, I think that if you have time, then have a small piece in the small caps, but then also have some of it in the large caps as well. I guess I'm not really picking. I'm not answering the question. I'm taking the easy road. But I think that's also the correct road, is to be diversified and have a little bit of both. Because if you do everything into the small caps, I mean, you could very well go into a period where just the big companies do well and the small don't. But you could also go into a period where the small companies do really, really badly, and maybe you lose money there, and you wouldn't lose as much in the bigger companies. So, like with most things in life and most things in investing, doing all of one thing too much, it can be where you get into trouble. So it probably makes most sense to do, to diversify it, to have pieces of both. What do you think, Budi?
Yeah, I agree with you, JJ. I think we don't need to put our money in one basket. Means that we need to diversify our asset allocations, also including in small cap and also big cap.
Yep.
Okay, JJ, you can continue.
Yeah.
Thank you.
I know in the United States, mid caps have been a great asset class that does almost as good as the small caps have, but don't move up and down quite as much as small caps. So it's been a really good asset class in the United States.
Yeah.
But I think
I think it's almost the same like in Indonesia. Small cap tend to have high volatility compared to the large cap.
Yep.
Means that it also has a riskier, but also has the opportunity to get a high return from the small cap. Okay, JJ.
Yeah, it makes sense that mid caps do well, because when you've grown to a large enough size that you've survived, you're not a baby anymore.
Yeah.
But you haven't gotten so big that you can't keep growing. You can still become a large cap. And so I think it makes just empirical sense that once you've survived to that threshold of mid cap status, that it puts you in a good spot to be able to keep growing to large cap status.
Okay.
So, anyway,
Okay.
Thank
you.
That's That's my thesis anyway.
Okay, thank you, Gigi. It's cool. You may continue with the
Okay,
portfolio.
thanks, Booty, and I appreciate you sharing your opinion as well.
Yeah.
So let's just finish up here about talking about actually doing, what these questions are leading us to, which is building the actual portfolios. And so much of this depends on your situation. It just depends on where you're starting from, where you're coming from, and where you're going to. But just keep in mind on the simplest terms, we're talking about cash, bonds, and stocks. And what I would add is that, I recommend people save up money in an emergency fund for cash, and don't really consider that your investment portfolio. That's just your cash. Its job is just to be there for you. Really, when you're talking about investments, you're talking about bonds and you're talking about stocks. The cash is just your emergency fund. Now, the most important factors, and this is not rocket science, this is actually really, really simple science. But the most important factors are, how long can you leave this money alone? Is this money that you need in 3 years, or is this money you need in 10 years or longer? And that's going to be the biggest impact, or the biggest factor determining whether or not you can invest in things like stocks. You need at least 5 years to, in my opinion, to be able to leave that money alone if you're going to start investing in stocks. And then you need to have some level of tolerance for risk. If you cannot bear watching your balances go down, then maybe stocks are not going to be a good fit for you. If it's going to, cause problems to your health because you're stressed out, that's not a good situation. So you have to understand who you are and understand your tolerance for risk. And maybe you have to learn that a little bit along the way. A lot of this also depends on how much money you're starting out with. If you're just starting out and you're just putting a little bit away every month, well, you can maybe have a little bit higher tolerance for risk for that, versus if you already have a bunch of money saved up and you're trying to figure out how to invest it, or you inherited some money and you're trying to figure out how to invest it. Maybe you have a different level of risk tolerance in that situation. So there's just so many factors, which is a lot of the reasons why you may want to talk to an advisor. But as you're building your portfolio, the first thing you want to do is really decide, what's my mix going to be of cash versus bonds versus stocks. And again, with the cash, I would say, get your emergency fund set up, have 3 months of expenses, 6 months of expenses, something in that range. And then the rest goes to bonds versus stocks. And then decide what types of stocks and what types of bonds you want. If you decide, I'm an aggressive investor, I don't need this money for 25 or 30 years, maybe I'm not even going to have any bonds, or maybe I'm just going to have a small percentage in bonds. It's going to be mostly stocks. Maybe I'll have some in Indonesia, some in other parts of the world. Maybe I'll have certain sectors, but that's where you decide, how much do I want in large? How much do I want in small? How much do I want to pick individually on my own? Maybe I want to take some and just pick my own. So, but the first step is decide, all right, how much do I want to have in risk versus non-risk? And so when I look at bonds, I consider that to be more of there's risk, but there's less risk. So you start out by figuring out, all right, how much am I willing to put into stocks, and then how much into bonds, and then from there you divvy it up. And I'll use some more examples here in the next couple slides. As I'd mentioned earlier, in the United States, a lot of times it makes sense to take advantage of different government sponsored plans where you can still own the same investments, but they'll be in some sort of tax shelter. And so I don't know what the situation is in Indonesia. Maybe Budi can share some of that as we move into the Q&A in a second. But you may want to take advantage of any plans that might be out there through either an employer or through the government. And then it's okay to change as time moves on. So maybe you started out by saving and you just put everything into a stock fund because you're just putting a little bit every paycheck in. And then 10 years later, suddenly you have a nice balance there. And you're like, wow, I've done really well. I want to make sure that I don't lose that. And so maybe you shift that balance and have a little bit more bonds over time. So, it doesn't have to stay the same. You don't want to get in the habit of moving it all the time. But as your situation changes, as you have more money saved up, maybe you want to treat how you invest that a little bit differently. Also, as you maybe get closer to needing that money, maybe you want to shift it into something more conservative. But it really does come down to your situation, what you can tolerate, and when you're going to need the money. But the longer you have, the more you can hopefully take advantage of the potential of owning investments in the stock market. Hopefully the risks will balance themselves out because you've given yourself enough time. So just give you a quick idea of what you might see a millennial in the United States' portfolio look like. And again, this is the United States, so it's going to look much different in different parts of the world. I'm assuming in this that the individual has already set their cash reserve aside, so they already have 3 to 6 months set aside, and so that's not considered part of the growth portfolio. It might be just this simple. Doesn't have to be terribly complicated. Maybe it's just 20% large caps, mid caps, small caps, international, and then some bonds. Maybe they're moderate aggressive, not just aggressive if they still have some in bonds. Maybe an aggressive investor would be all equity. If this person's 55, maybe it's more like 60-40 or a 50-50 mix. It also depends on how much they've saved up. If it's a 55-year-old that hasn't saved up much, well, maybe they treat that differently versus a 55-year-old who's saved up a lot of money. So it just depends on the situation. So with that, that's all of the prepared slides, remarks, that sort of thing that I have. We have quite a bit of Q&A time set aside. And I'd be curious, Booty, if you can share, are there any types of retirement plans in Indonesia, any type of tax shelters that the government provides for people to save for their retirement?
I think as far as I know, in Indonesia, we have kind of the pension fund, under the banking sector. For example, if I want to prepare my pension or retirement, I can go to the bank and maybe ask with the officer there, and we'll try to open up like the saving for the investment for the retirement in the future. So they will try how much money that you are going to achieve when you are retired, and all this is you have to allocate your money, how much money that we need to allocate monthly. That's all I know about the pension fund in Indonesia.
Gotcha.
Okay, Gigi, thank you so much for the presentation. I think we have a lot of questions need to be answered. I think the first question is all about the financial advisor. I think it's based on your your expertise, I think.
Okay.
Okay. First question is, can you hire a professional, financial professional, if your goal is more long term? And also, is there a time limit to hiring professional?
Yeah, I mean, I think that if your goals are long term, short. I mean, hopefully, if you're investing, your goals are long term. If your goals are short term, hopefully that means you've got like cash flow things you're trying to figure out, that sort of thing. You shouldn't invest for the short term. You're it's often like gambling. So I think that the decision on whether or not to hire a financial advisor doesn't really matter whether you're looking short term or long term. It just might need to make sure that if you hire a financial advisor who specializes in investing, they may not be able to help you if you're needing help getting out of debt or something like that. So make sure that you match whoever you hire with what your goals are, that they that you're the type of person that they help, you're their type of client. Because some advisors, they may only help a certain type of clientele. So I don't know if that answered your question or not. Was there a second part of that question?
I think the second part is there a time limit to hiring professional? Is there any time limit, JJ, to hiring?
Yeah, and I don't know what I don't know of any time limit. Usually, the way that you can hire a financial advisor is you work with them from year to year. Over hopefully a long period of time. You'd rather not get somebody that just gives you advice once and then you never talk to them again. That's probably, you'd rather have somebody that is going to be there to build a relationship with you for many, many years. That's how I try to work with I'm a financial advisor, and that's how I try to work with my clients is, we constantly checking in every few months and reviewing things and seeing if there's any changes need to be made.
Okay. Maybe you can also share, Gigi. What about the payment? I mean, the procedure between the client and also the financial advisor that common apply in the USA. Maybe
in terms of the payment, you say?
Yeah, I mean the payment mechanism, for example, like the financial advisor fee or something like that.
Yep. Yeah, no, really good question. And no matter what, you want to make sure you ask anybody this if you're going to work for them. Mm-hmm. In the United States, most often the way you would pay is if the financial advisor is actually managing the money, meaning you invest through them, then they may charge a percentage of the assets. For example, I charge anywhere from 0.5% to 1% of the money that I manage as a fee. You can also sometimes, and I will sometimes do this as well, we'll just charge a flat fee. Okay. Someone will just pay me a check or a monthly thing where they just giving me that as a fee for the advice. And then sometimes there will be what's called commissions. Okay. Meaning if you put somebody in a certain investment or you sell them life insurance or something like that, then whatever product it is, mm-hmm. they will pay the financial advisor. You may see it come out as a commission that you actually see. Sometimes it's hidden in the product, and so the commissions can get pretty complicated. But usually those are the ways that financial advisors get paid, is either on a straight flat fee, a percentage of the assets, or through commissions on different investment or financial service type products.
Okay, thank you, Gigi. There are some variety of scheme of the fee between the client and also financial advisor. Okay, thank you, Gigi. I think the next question for me, for Mas Budi, how do you find an advisor in Indonesia? Maybe then I try to answer because this question for me, maybe JJ also will help me to answer the question how to find an advisor in USA. But I would say that, frankly speaking, I don't have a financial advisor yet. But yeah, if I have to choose one, I think I will pick up JJ because I have because I have read his book. But I would say that the first variable that need to be concerned before picking or selecting the financial advisor, that I agree with JJ, we need to dig more detail to find out about his or her experience, because his experience or her experience will create his or her expertise. So the question is how to measure, the financial advisor expertise. For me, the easy way is about the accuracy in terms of looking at his or her performance. How do we do that, which is her or she or he can do a better performance or not? I think it's easy just to compare with the benchmark, like what JJ said. Maybe in Indonesia, if we want to invest in stock market, maybe we can compare with the Jakarta Composite Index. Maybe if we want to invest in mutual fund, maybe we can uh, benchmark with the average mutual fund return, and so on and so on. So we have to know the benchmark, and maybe we can compare with he his or her uh, you know accuracy in terms of projecting the financial uh, price. Okay, Gigi, do you have any insight about how do you find an advisor maybe in USA or in general?
Yeah. No, and it's an important question, and it's not an easy one to always answer, but it's an important one. I would start by um, asking people you know, if you have anybody you know that has a financial advisor that they trust and that they like. That's usually the best place to start. Is that way you're not just picking somebody randomly. Um, so I would start there. If there's anybody that just friends, family that has somebody that can refer you. After that, I would look to other professionals in your life. So if you have a relationship at a bank, if you have a relationship with any other types of professionals that might be able to give you a referral for somebody, that's usually another good place to start. Um, I know in the United States, you can do what's called a broker check, meaning you can look up a person's regulatory history online. I don't know if there's anything like that in Indonesia. I feel like there is something like that in Indonesia, but it's always good if you do find somebody to do a quick background check on them to make sure that they, their story matches up,
Yep.
and that they are indeed registered. Um, but that's how you start, is just by asking the people you know. That being said, I know people who have found their financial advisor by just calling a bunch of people
Mhm.
off of the internet or out of the local paper, and just interviewing several people until they found somebody that they connected with.
Okay, Gigi. I think in Indonesia also the financial advisor usually do the final check up first of the client before give some recommendation to the client which asset allocation that need to be allocated to invest. I mean, okay. Okay, okay, Gigi, we are going to continue the questions about bond market. How does bond rating relates to credit quality?
Yep.
What do you think, Gigi?
Yeah, so that's no good question. So the bond rating is direct. It relates directly to the credit quality, meaning if it's a bond that everything looks good, that it's most likely not going to have any problems of default, then the rating will be good. And if it looks like there might be problems, then that's when the rating will be lowered. So, a triple A is the highest, then C is the lowest. So triple A means that there's very low risk of default, and triple C means that the risk is much higher. And then within each of those triple A, triple B, triple C, there's other levels within that: double B, single B, etc. And then there's pluses and minuses as well. But yeah, you know, if you see that a bond rating has been lowered, it means some bad news probably came out along the way somewhere.
Yep. Okay, agree with that, JJ. But I think if we look at, if we went back to the global financial crisis back then in 2008, 2009, if I'm not mistaken, the rating agency gave the AIG, one of the biggest insurance company, right? Triple A credit rating, but not longer time since then. The company collapsed because of the global financial crisis. So there was debatable among, like I said, like academician and also the practitioner in terms of the financial market. Do we need to believe in the rating agency, or maybe we need another indicator in order to value or give a rating for the company? What do you think, JJ, about that?
No, I think you make a very good point, and one that I'm glad you made, because it's, I guess it's been 12 years since the credit crisis. I've already forgotten some things already, but no, you're exactly right, because not only did AIG, were they AAA rated, and so many of the other banks, AAA rated along the way, Lehman Brothers, who, wiped their bondholders and equity holders completely out. The ratings agencies lost a lot of their credibility, because not only did they misrate all of those institutions, but they misrated all of the paper that was coming out of those institutions in the form of mortgage-backed securities. So you had all these mortgage-backed securities where they would take all these mortgages from the United States homeowners and divvy them up in different ways, and decided, well, as long as we have, all these different varieties of high risk debt, then the risks offset each other and it's AAA. Well, it turns out those risks didn't offset, that all those high yield, homeowners started to stop paying their mortgages at the same time. And all this AAA paper was indeed just high risk mortgages that people walked away from. And that's how we had the financial crisis. And so, it's a really good point that the ratings agencies missed on both accounts there. I think that since then, they've tried to compensate for that. You never know whether they are really compensating for that, or they overcompensating for it, maybe in some manners. But traditionally what you see happen is the ratings agencies show up after the news came out. They don't predict the weather. They tell you what the weather just did, So
Yes.
You kind of take that with a grain of salt. Oftentimes when they finally downgrade something, that's the turning point. Now it's going to bounce. So, in that respect, there's correlation, but you could argue that the timing can be, unfortunately, a little bit lagging, versus an analysts. They're trying to look forward a little bit more than maybe some of the ratings analysts would. More of an equity analyst, a bond analyst. They may be trying to look around the corner more than just a normal credit agency analyst would.
Okay. Thank you, JJ. I think it's very clear explanation. Talking about the crisis, subprime mortgage crisis back then, in 2008 and 9, and now we are facing the pandemic outbreak that also crashed the economy all over the world. Indonesia, GDP minus 5% in the second quarter, and also the third quarter we was minus 3%, and also in America also we are facing a recession economy, and there is also a question related to race. How do I measure the risk tolerance before investing, and what are the key parameters? So how do we measure the risk? JJ, what do you think?
So, racial tolerance within your investing?
Yes.
Yeah. Wow, that was not a question I expected to get, and I don't know that I have a good answer. It's something that, as a individual and as an investor, it hasn't really ever impacted how I think about how to invest. I mean, I definitely think that, especially in the United States, there's definitely some level of systemic racial profiling, where if you don't come up in a household where people talk about finances, then you're definitely at a disadvantage, and that's going to be socioeconomic. And so I believe all that exists. But when I think about how to, whether I'm buying this stock or that stock, or whether I'm buying these bonds or that bonds, and how I kind of put all that together, I've never once thought about race within that. Now, that being said, there's a huge movement in the United States for what's called ESG, environmental, social, and then either green or governance. I hear people use both, but towards accountability on corporate boards, for corporate level stuff, to make sure that there is equality, make sure that we're good citizens as corporations. And so there's a big movement for that, and there's some people I follow on Twitter that are pretty vocal about feeling like we need to do a better job of focusing on ESG, that it's more than just a buzzword. But there is definitely a movement around kind of social aspect of things within investing, that it's always been kind of treated as a fad, at least in my 20 years, that people kind of pushed it away. Oh, it's just a fad, this idea of socially investing. But I feel like every year it gains more and more of a foothold, and especially 2020 is a year where, I think it's important to a lot more people in the States than ever before. But I don't know how that applies to Indonesia.
Oh, okay. Oh, I agree with you, JJ. I think currently, social investing or impact investing are getting more familiar, and get used to of the people around the world, including Indonesia. But I think if I can add how to what are the key parameter of risk, I would say that there are market risk and also non-market risk. During the pandemic crisis, I think we have, high market risk, means that we cannot control the risk. But I think what we can control is we can control our portfolio. Like you said, maybe we can diversify our asset allocation, not only in single financial instrument, but also we can diversify in some financial asset. For example, some in stock, some other in bond, and also mutual fund and other financial asset. Okay, thank you, JJ. Thank you so much. I think we still have another questions. Is about still talking about the financial advisor. The question is an advisor immediately your fiduciaries?
So it's going to depend on where you are. I don't know the rules in Indonesia. In the United States, not always. So fiduciary means that they have to do what's in your best interest. In the United States, just to give you an example, some advisors are fiduciary, where they have to do what's in your best interest. Some are just held to what's called a suitability level, meaning they just have to recommend something that is suitable for you. Doesn't necessarily have to be in your best interest.
Okay.
But there's more of a movement towards everybody being a fiduciary. Within the next couple of years, everybody in the United States will most likely be a fiduciary. But I don't know what it is in Indonesia.
Yeah. I think you need to ask the financial advisor directly. Maybe one financial advisor has different, approach to another one.
Yep.
Okay. Yep. Thank you, JJ. I think there are also another questions on Instagram. Okay. About the stock need to avoid. What do you think, JJ? What kind of stock should I avoid?
Ooh, that's as good a question as any. Stocks to avoid. I mean, a lot of times, that's as important to think about as anything. I would say anything that looks like it's going to be permanently altered because of how quickly the world got used to doing things like what we're doing right now, getting on a Zoom video. How quickly we've gotten used to doing things electronically. So when I think about, I don't know how things are set up in Indonesia, but in the United States, I'm curious what real estate looks like in the next 5 to 10 years, specifically commercial real estate.
Yep.
Because I think of things like banks.
Yep.
Banks were already bank branches. We have way too many bank branches in the United States. Now, what's that mean for bank stocks? I don't know. Maybe it's good because they don't have to run all these branches everywhere. But I think that anytime you see some trend that is good in one area, you got to look at who's getting hurt by that. So be interested to see interested to see how real estate moves in the United States. Things to avoid. A lot of those things that have been avoids may start to come back now, because I think of things like oil and banks. I've been saying avoid those for a long time, but I don't know that I want to say avoid anything right now. Shifting right there. So I'd say avoid being overweight any one thing too much right now. I think you want to be diversified as much now as any time in the last 5 years. Just because technology has run so hard that it could take a break, and that can be messy if it takes a break, but it might just keep going because of all these trends that are in place. So I think you want to own value and growth. I think you want to be diversified.
Okay. Thank you, Gigi. Talking about the real estate in Indonesia, the central bank of Indonesia just decreased the interest rate. If I'm not mistaken, it became 3.75. I think it's quite low in Indonesia. So I think it has a positive impact in the property stock. Because I bought one of the property stock, and I just sold my portfolio. Oh my God, I got a triple. I got double growth in single day. I just impressed that the stock is very rely on the the macroeconomic variable policy that has been made by the government through the Central Bank of Indonesia. Okay, you will continue the other question from you know. Okay, the question is, when it comes to buying and selling, some dealers are really high price, while some other are really low. So it's all about the the what we call uh, the price when we are buying or when we are selling stock. Some dealer are uh, charge the high price and also some low price. How is that possible? What do you think, Gigi?
So is he asking about the commission?
Yeah. About the commission, I mean, high
Yeah.
commission and low commission.
Yeah. So I would find out, if they're not giving you any advice, then, anybody can make the trade. I mean, in the United States, the commissions are zero. So, there's no need to pay a high commission. They're not going to do anything more for you. Now, if it's an advisor where they're giving you advice and that's how they get their income, well, then that's where you have to decide, is it worth to pay a higher price to get this person's advice, or am I better off just doing it on my own and doing it for cheaper? But if it's, just an account to open up to buy stocks or bonds in, and you're doing it all on your own, then as long as it's a reputable company, then I don't see any reason to pay a high commission. But I'm not an expert on the Indonesian brokerage environment either.
As far as I know, in Indonesia, the commission is around maybe for buying, if I'm not mistaken, 0.2%, and also for the selling 0.15% or something like that. But I think it's interesting, Gigi, when you said that zero commission in USA. And my question is, how does the investment company create revenue if the commission is zero?
Yeah, so that's a really good question, how they make money. I know, so for one, there's one avenue that they'll make money is they will partner with financial advisory firms that do charge fees and make a referral arrangement that on a different portion of their clientele, they're making money that way. But also they will, there's some behind the scenes, brokering of the securities that are held where there's a gap or there's a spread in between what they're buying and selling at in some areas. And so they will make some money that way, but it's not anything that's very transparent. But it doesn't necessarily cost the customers anything. I mean, it used to be, it would be 1% to buy or sell something when I was a teenager, and then it became $20, then it became $10, and then it was $5, and then a year ago it went down to zero. But it's a good question. How do they make their money? I've read some articles that explained it, but I never quite understood exactly how they make their money. But I know it has to do with brokering stuff behind the scenes and with taking a spread on that.
Okay. Okay. I think it's one of the reason also why the stock market participation in America is higher and higher, because the commission is zero, right? Compared to other countries like Indonesia, we still have the commission fee is relatively higher. Okay, thank you, Gigi. Okay, we continue the question. Is about stock transfer. Gigi, what do you think about stock transfer? Are stock transfer worth anything?
I'm not sure what is.
Uh, I also cannot understand fully about the question about the stock transfer. But what do you know about the stock transfer, Gigi?
Um, One thing I know about it when I think of a stock transfer would be just a stock, transferring from one account to another. I'm not sure what he could be asking.
Yeah, because he or she just asking, are stocks transfer worth anything? Maybe is the selling and buying process from one seller or
Yeah, I'm not sure. I mean,
yeah.
yeah.
Okay, but yeah, but it's okay. Mm. JJ, let's continue. I think when we are talking about the investment, means that we are talking about the future, but we need to look at the historical perspective, right? JJ, I would like to ask you your opinion or your perspective about the future of the financial industry. Because you know here, I mean, currently we are facing like what uh, people known as the black swan, means that sometimes that we never imagined or we never even predicted, like the COVID-19 pandemics. It's happened in 2020, like supermarket crisis and other crises. Gigi, what do you think about the future uh, in terms of the economy, and what is the best, I mean, asset allocations between among stock, mutual fund, and bond? What's your opinion, Gigi?
Yeah, no, I tend to be overly optimistic of things. Um, I think that everything that we've gone through in 2020 will make us stronger on local levels, on familial levels. I think that it will help just refocus humanity on hopefully what's important, and and maybe shift some economies as well. And I think that technology allows our economies to become a little bit different in that you can manufacture stuff closer to home wherever you are. You may not have to have quite such globalized supply chains that even for Indonesia, that there's things that maybe you used to have to import that you won't now, that everything from 3D printing to robotics to all the things that we've seen developed over the last 30, 40, 50 years. I think that it can really help all the local economies thrive without having to rely maybe as much on some big international partner coming in to make it all right. So I get pretty optimistic when I see all the technology shifting things the way it has, that we've got to get around the corner on this disease. We've got to get around the corner on COVID, but I feel like we will. And I feel like when you push humans into the corner, they tend to react pretty well. And we try to, we'll develop things scientifically quicker than we would have otherwise.
Mm-hmm.
And I think that while it looks a little bit dark right now, the reason you've seen the markets rally the way they have, this summer and even into this fall, is trying to look around the corner towards some of the optimism that hopefully comes out of what's happened.
Okay.
But you asked, what about the financial industry? I mean, I feel like from what I hear about Indonesia, it would be it's probably a growth industry in Indonesia. It might be tough to call it a growth industry in the United States. It's so mature, so saturated. I mean, we could go on and on. There's all sorts of market dynamics that it's not a growing industry in the United States, and there's going to be a lot of things that change how it's structured. But Indonesia is quite the opposite, because you've got a good growing middle class. You have young people, and you have a maturing financial system. All the mutual funds, that sort of thing, they've maybe been out in the United States for a longer period of time, and in Indonesia, it's you're seeing innovation at a higher rate. So I feel like it's a growth industry in a place like Indonesia.
Okay. Thank you, JJ. Yeah, I think the financial market in Indonesia is still growing, because there is still a room, to improve. For example, the stock market participation is relatively low compared than the developed country like USA, and also the market capitalizations compared than the percentage of GDP is relatively below the 50%. Some other developed country maybe it's more than 100%. So maybe it's yeah, I think we are still bank system minded rather than financial system minded, but I think it's going to be moved a little bit in the near foreseeable future. Okay, JJ, I think we are in the final session. Before we end up our session today, maybe do you have the final remark regarding our topic, that financial resiliency for millennials during the pandemic 2.0? Yeah,
Yeah,
what is your final remark?
my final remark would be that it's not how much you make, it's what you keep. And if you can just get in the habit of every time you get paid, put a little bit away, either into cash as an emergency reserve, or start to invest, a little bit every paycheck. Next thing you know, you've saved up a nice amount. And so you don't have to start with a lot. Just start doing something, and eventually you'll end up with a lot. So that'd be my main thing I'd like to say, is just get started. Even if you don't have a lot now, do what you can with what you have.
Okay, thank you so much. Thank you so much, JJ. Know your risks and start investing early. I think it's also the good advice. Thank you, JJ. Thank you very much for your time. Thank you very much for your knowledge and your sharing for the Indonesian millennials audience. Hopefully, we can see you again, JJ, and listen in your uh, your knowledge sharing and other stuff related to the stock market. And hopefully, you can inspire people through your book, teaching kids to buy stock. And hopefully, more Indonesian and also more people around the world are willing to start investing early in order to have the better wealth for them in the future. Thank you so much, JJ, and have a nice day. Okay, I will give back to Mr. Anton. Thank you.
Okay, thank you, Mas Budi, and also JJ for the wonderful session that we just had. And I hope that we are now more resilient as millennials in for with our financials. And earlier in the event, I asked you guys an icebreaker question, and that question was to maintain a low debt to income ratio, what is the maximum amount of our take home pay we should use for monthly debt payments? Is it A, 10%, B, 15%, C, 20%, or D, 25%? And the correct answer is B, 15%. Unfortunately, nobody got the answer correct for today's quiz, but don't worry, we will have more quizzes on the next episodes of Ad America TV, so stay tuned. And now you might be wondering, how can you develop an awesome idea for a place like this? Well, wonder no more. You can come straight to our website at www.atamerica.or.id, click Create an Event, and collaborate with us and submit your proposal there. All proposals will be reviewed, and your event might just end up here very soon. And while you're on our website, don't forget to subscribe to our newsletter so you can receive information about our upcoming events sent straight to your inbox. Well, folks, this has been Financial Resiliency for Millennials during the pandemic. Don't forget to follow us on social media and also subscribe to our YouTube channel. And with that, we hope that you guys are staying safe. Thank you for tuning in, and we hope to see you again at the next Ad America TV event. Goodbye, everybody.